Welcome back to Talk Tickers. We're the show that rips open the quarterly earnings calls to figure out what's really going on. Today, we've got a fascinating one, a small cap turnaround story in the making. We're talking about Rocky Mountain Chocolate Factory, ticker RMCF.
It really is a fascinating setup. You've got a company telling two completely different stories at the exact same time. It's a real Jekyll and Hyde situation on the tape.
And the market could not figure out which story to believe. I was watching on Saturday, and the price action was, it was schizophrenic. Pre-market, the stock is up, over 7%?
Looked like a breakout.
It looked like the bulls were ready to go. Then the bell rings. People actually read the report, and by the close, it puked. Finished down 7% at $1.99.
And that volatility, that tells you everything. The market is, it's efficient, but it's also incredibly impatient. The algos saw the headline on gross margins, and we'll get to those. They're genuinely impressive, and they just hit buy.
Right.
But then the humans logged on, saw the top line revenue, and went, wait a minute, this company's shrinking.
It's the classic dilemma, right?
Yeah.
Are you shrinking to profitability, or are you just shrinking? So let's get into the numbers that caused all that whiplash.
Okay.
Headline revenue was $7.5 million. That's down 5.1% year over year. And, in any other world, a 5% revenue drop is a huge red flag.
It's a disaster, usually. It means you're losing customers. But here, the context is everything. Management is basically shouting that they fired these customers on purpose.
They fired them.
They're getting out of low-margin wholesale deals, basically saying, we're selling a ton of chocolate to this channel, but we're not making any money, so we're just stopping.
So it's cutting the bad revenue, addition by subtraction.
Exactly. It's sanity over vanity. A lot of small companies just chase that top-line number. RMCF is doing the brave thing, and if you look at the bottom line, you can see it's working.
Okay, let's go there. Net loss was $200,000. Now, if you're just listening for the highlights, a loss is a loss. It doesn't sound like a win.
But you have to look at the trend. A year ago, the same quarter, they lost $800,000.
Okay, so that's a big improvement.
It's a huge improvement. That's a loss of 11 cents a share then versus just 2 cents now. They've almost closed the gap to break even. And if you look at EBITDA, it's even clearer.
All right, pause there. We say EBITDA all the time. For anyone listening who isn't an accountant, why do we care about that more than just the net income number?
Sure. So EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a mouthful, but think of it as a proxy for the raw cash flow from the business itself. It asks one simple question. Is the actual act of making and selling chocolate generating cash?
And for RMCF, the answer is?
The answer is now yes. Last year, EBITDA was a loss of $0.4 million. This quarter, it swung all the way to a positive $0.4 million. The core business is finally printing cash again.
That is the pivot. But the metric that really blew me away, and this must be what caused that pre-market pop, was the manufacturing gross margin.
That's the star of the show, absolutely.
It hit 21.4%. Just for context, a year ago it was 12.9. Last quarter, it was negative.
They were literally paying people to take their chocolate. That's the whole bull case in a nutshell. The factory is fixed. You can't build a company if you lose money on every bar you sell. And they went from negative to over 20%. That proves the operational fix is real.
Management's calling this their margin-first transformation.
Yeah.
It sounds a little like a corporate buzzword, but how are they actually doing it? You don't double your gross profit by accident.
No, it's a total overhaul on operational diet. It started with SKU rationalization.
Okay, that is peak MBA speak. So they've just stopped making candy that nobody was buying.
Pretty much. A SKU is just a product code. They went through their whole list, hundreds of items, and for every single one they asked, does this make us money? If the answer was no, it got cut. It just simplifies everything on the factory floor.
Makes sense. Less complexity.
Then they cut temp labor, they cut overtime, and they added a second shift.
Wait, how does adding a shift save money? That seems counterintuitive.
Because you stop paying time and a half for overtime to a rushed, tired crew at the end of the day. Instead, you split the schedule, you run the machines longer at a standard rate. It's all about efficiency.
And pricing?
And pricing. But they didn't just jack up prices on everything, they called it surgical.
A scalpel, not a sledgehammer.
Exactly. Some prices went up, some stayed flat, and some they actually lowered to push a better product mix. It shows they're finally using data.
Which implies they have data to use now.
And there's a physical signal of this change, too. Did you catch the detail on the packaging?
The copper boxes.
Hey!
Phased out November 30th, I saw that.
Gone. The legacy copper packaging is gone. It seems like a small thing, but in a turnaround, it's a huge signal to franchisees and customers that the old RMCF is over. It's modernization you can actually see on the shelf.
Speaking of old problems, we have to talk cocoa. The cocoa market has been, for lack of a better word, just broken.
Broken is being kind. It's been parabolic. I mean, historically, you're talking $1,500 to $3,000 a ton. It spiked to $12,000.
Which, if your company has chocolate in the name, is basically a 5-alarm fire.
It's an existential crisis. But they navigated it surprisingly well. Prices have pulled back to around $5,100, which is still really high, but management pulled off a pretty smart hedge.
Okay, explain a hedge quickly. It's like insurance, basically.
Think of it like pre-buying your gasoline. You lock in a price today for all the gas you'll need next year, so even if the price at the pump doubles, you're still filling up at the old price. RMCF did that. They locked in about 20% of their supply at around $5,000 a ton.
So they have some certainty while their competitors are getting tossed around in the spot market.
Correct. And they got another gift, too. A 10% tariff on cocoa was just eliminated.
Oh, wow. That's pure profit. Goes straight to the bottom line.
It does. So between the hedge and the tariff cut, they've turned this terrifying variable into a predictable cost, which is critical if you want to do that surgical pricing we talked about.
Okay, so let's recap. The factory is fixed. The cocoa risk is managed. The bloat is cut. The diet is working. But, and this is the big one, you can't shrink forever. At some point, you have to grow.
And this is where the call went from playing defense to playing offense. And it's what got those pre-market traders so excited. They announced a massive area development agreement.
34 new stores.
34. For a company with a network of about 250 stores, that is a huge deal. It's more than 10% unit growth from a single contract.
And these aren't just random people. They describe the partners as well-capitalized and financially sophisticated.
Which is key. Franchising is hard. If you sell to someone without deep pockets, that store is going to fail. These are 3 existing owners doubling down and 1 new one. They know the business. And 2 stores are already under construction.
Under construction. That's the key phrase. A contract is paper. A bulldozer is real.
It is. But here's the reality check. This is why the stock faded. There's a lag, a huge lag. They said it's a 4 to 5 year build out.
4 to 5 years. In this market, that's an eternity. Why so long?
It's just the reality of retail. You sign the deal, great. Now you find a site. You negotiate a lease that's 2 to 4 months, permits, then a 6-month build out. And even when it opens, a store takes 3 years to reach maturity.
So the revenue from this amazing news isn't hitting the P&L next quarter. It's a 2027, 2028 story.
Exactly. An investor sees the headline, growth is here, then they see the fine print, growth is coming, eventually.
They did give us some unit economics, though. They're targeting $1 million in sales per store.
Which is a very healthy number. And remember, for corporate RMCF, that's royalty revenue.
The best kind of revenue.
The highest margin. The franchise pays for everything, corporate just collects a check. If they actually get 34 stores doing $1 million a year, it's a gusher of free cash flow.
But again, if. And investors today are looking at revenue down 5% and being asked to wait 3 years. That's a tough pill to swallow.
It is. The stock price fell right into that gap between the current reality and the future promise.
One thing that could help bridge that gap is their tech stack. They spent a lot of time talking about their new point-of-sale system. Over 120 stores are on it. Why is that such a big deal?
It's about data, visibility. Before this, corporate was flying blind. Now, with the new POS, they can see basket composition.
Meaning what people are buying together.
Exactly. They know the average ticket size. They finally know who is buying the chocolate and what they're buying with it.
So they can run promos. If you buy a caramel apple, maybe you get a discount on dark chocolate or something.
Yes. Better inventory, smarter marketing. You can't manage what you can't measure. And they're extending it outside the store, too, with white-labeled DoorDash storefronts.
Which is a no-brainer. 0 commission for the franchisee. Just pure incremental sales.
It all shows they're trying to act like a modern, tech-enabled retailer, not just some dusty old candy shop. But again, these are investments that cost money now for a payoff later.
So let's zoom out. The so what of it all. Margins up, pipeline full, tech improving, but the stock dropped. Was it just the revenue lag or was something else spooking people?
The balance sheet, and more specifically, the D word, dilution. They raised $2.7 million in equity after the quarter ended.
Okay, explain dilution like I'm 5.
Imagine the company is a pizza. You own one slice out of 8. Management needs cash, so they cut the whole pizza into 16 slices. You still have your one slice, but now it's a much smaller piece of the whole pie. Your ownership got diluted.
And investors hate that.
They hate it unless the money is used for something explosive. Here, they used it to pay down some debt and for working capital.
So they diluted shareholders to pay the bills.
It's responsible, it's prudent, but it's not sexy. It signals stabilization, not hypergrowth.
And to be fair, the stock had a great run before this. It was up 24% in 3 months, crushing the S&P.
Which means a lot of the turnaround story was already priced in. Traders bought the rumor. Then the news was just good, but not great, so they sold the fact. The market is demanding durable, profitable growth. RMCF delivered the profitable, but the growth part is still missing.
So now we wait. We're waiting for that golden cross moment where the new stores start opening before the revenue cuts fully bottomed out.
That's the whole game now. Management is doing exactly what they promised. They're fixing the house. But investors are standing outside, tapping their watches, asking when the party starts.
It feels like they've gone from survival mode to construction mode, and construction is just messy.
It is. But you can't build a 34-store expansion on a broken foundation. They've fixed the foundation. Now comes the hard part.
All right, that brings us to my favorite part of the show.
This is not financial advice.
Let's be clear. We are literally guessing. Do not do this. We are not your advisors. But if we were spitballing in a closed-door meeting, what's the trade?
I've been kicking this one around. I'm calling it the chocolate arbitrage strangle.
The Coco Loco spread, maybe?
Ah.
What's the setup?
Okay, so you look at the macro picture. The consumer is getting squeezed. Credit card debt is up. People are pulling back on big purchases.
Recession fears are back. People are tightening their belts.
Exactly. But you have the lipstick effect, right? When times get tough, people start buying the car, but they still buy the small, affordable luxury to feel good, a nice lipstick, or a box of premium chocolate.
So RMCF is the lipstick. What's the other side of the trade? What are you shorting?
The short side is the Consumer Discretionary Select Sector, SPDR, the XLY.
Whoa. So you're going long a tiny chocolate company and shorting the entire consumer sector. That's ambitious. Hear me out. It's a bet on the specific versus the general. RMCF is fixing its own idiosyncratic problems. They've hedged their costs. They have a tariff tailwind. They're becoming a high-margin royalty company, decoupling from the macro.
While the XLY is completely exposed to it.
It's all the car companies, the luxury retailers. The big stuff people stop buying first. So if the economy really slows down, XLY gets hit.
But people still buy a $20 box of chocolates as a small treat.
Precisely. And here's the kicker. If those 34 stores actually open on schedule, RMCF becomes a royalty cash cow no matter what the broad economy is doing. You're long a specific company's execution and short the general consumer fatigue.
The small treat versus big purchase spread, I love it. It's completely reckless, but the logic is there. Again, listener, please do not do this.
It's just a way to frame the story.
So to wrap it all up, margins are way up to over 21%. Revenue is down, but on purpose. And the growth pipeline is finally loaded. The company isn't bleeding anymore. Now they're building. The stock drop is a penalty for the timeline, not a verdict on the business. It's the market saying, show me.
Management is saying, trust the process. The market's saying, show me the revenue. We'll be watching to see which one blinks first.
If those under construction signs start turning into grand opening signs, this stock has room to run. If they don't, then it's just a smaller chocolate company.
So we want to know what you think. Do you prefer the margin-first diet, or are you hungry for revenue growth? Let us know your take on the RMCF turnaround.
It's going to be a fun one to watch.
Talk Tickers signing off. We'll see you at the opening bell.